So today we'll finish up our discussion on returns and then get into one of my favorite topics, which is I love risk. Measuring risk is one of my topics to talk about because I think we should maybe challenge the way we do it, but we'll talk about some of the most common ways we measure risk and especially focus in on this concept of beta. So last class we said we're going to be using the holding period return simplified formula, ending market value minus beginning market value plus accrued income divided by the beginning market value. We're ignoring the timing of cash flows, so the modified deeds is a more sophisticated way, but as long as we don't buy anything new or sell anything during the period, then the holding period return will get us pretty close. And then we said the incredible importance of the ex-dividend date. That's the date that tells us that that income is ours. That's the day we want to put the income into our formula. So if the ex-dividend date's in February, we want to add the dividend into our February calculation of holding period return. If the dividend is declared in January, goes ex in February, and is paid in March, February is the date we use. So be careful of that on the exam. Wherever you see the X date, that's the month you want to put the dividend in. All right. So let's work an example from the exam. So this is what it will look like on the exam. We'll do a few more of these throughout the semester as we get ready, especially right before the exam. So I don't want to do a bunch of them because it's pretty straightforward. You just plug numbers into a formula, so I don't want to do multiple versions of it. You should be able to figure this out on the first try because it is really quite straightforward. So I give you several months of returns. The only thing tricky I sometimes do is I'll switch the order, and that's not even intentional. It's just, do I put it from earliest to latest? But it doesn't matter because you can't do August return, because to do August return you'd have to have July 31st price. So remember that the beginning market value is the prior month's ending market value. So I can't do August return because I don't have July. So I can do September, October, November. September's beginning market value is 68.42, ending market value is 68.19. October's beginning market value is 68.19 and ending market value is 57.21. And then November, ending 62.22, beginning 57.21. So there you got your data. So remember the formula is ending market value minus beginning market value plus accrued income divided by beginning market value. Now they have a dividend of 28 cents. They announced it in September. It went ex in November and it was paid in December. Well, there X dates, all you care about, you're going to put that dividend in with your November calculation. So we'll start with November. You can start with November or September, it doesn't matter. So the ending market value is 62.22, beginning is 57.21, and November is the date that we want to put the dividend in, the 28 cents. So we take $62.22 minus 57.21 plus the accrued income divided by beginning. And I would encourage you, don't use percent signs. Put everything in terms of decimals. It will just make things much, much, much easier for you. So October and September there is no income, so it's just the ending minus the beginning, ending minus beginning. So that gives you negative 15% for October and negative 3.0034%. All right, so there's your three holding period returns. Now what we want to do, so we got our holding period returns, we're done with that. Now we want to get the arithmetic average and the annualized arithmetic average. Well, the arithmetic average is just those three numbers added together and divided by 3. If you have 3 months, you divide by 3. If you have 5 months, you divide by 5. So 0.0876 minus 0.1569 minus 0.0034. You take those, and their average is actually negative 0.242. Now, how do you annualize that? So there's the arithmetic. The arithmetic's very easy. You just take the average of the numbers. The annualize with arithmetic is really simple. If you're using monthly data, then you multiply by 12. If you're using weekly data, then you multiply by 52. So negative 0.0242 times 12 gives us negative 29.08. Now you could have some rounding issues. If you did this in Excel, then these will go out many more decimal places than that. But essentially, minus 2908, minus 0.2908. And notice there's a footnote here. What does the footnote say? The CFA, you cannot annualize numbers, periods of time, if it's less than 1 year. Here we only had 3 months, so we can't annualize it. If we had 32 months, we could take the sum of all those divided by 32, and that we could multiply by 12 to annualize it. But you can't annualize 3 months, 4 months, 5 months. There's the arithmetic, very straightforward. Make sure you put the footnote on there. I do count that on the exam. Now the geometric is more difficult. With the geometric, what you're going to do is you're still going to take all 3 of these returns, but you add 1 to each one, and look real carefully at the parentheses. You add 1 plus the first month, so 1 plus 0.0876, put parentheses around that. That entire thing is time 1 plus the second month, with parentheses all around, times 1 plus the third month. You take all of that, so you should get 1, well, you'll get 0.9 something here. You raise it to the 1 divided by the number of months that you have. Here we have 3 months. On the exam, I may give you more months because we're going to be doing this. You can do it in Excel. But here I gave you 3 months. So you take the 3 months, you multiply them all together. So essentially saying we had $1 and we made 8.76%. So we take that $8.76 and then we lose 15% of that. So now what do you have? And then we lose 3.4. So you're linking them together, so you're essentially compounding. And that gives you a return of negative 0.0296. And the geometric average will always be lower than the arithmetic average on the monthly basis, not on the annualized basis, but on a monthly basis. So you notice that 0.0296 negative 0.2096. It's lower. Now if these are positive numbers, if this was positive 242, this would be like positive 2.32. So it's always further away from the numbers. So if it's a negative number, it will be more negative. If the arithmetic is a negative number, the geometric will be more negative. If the arithmetic is a positive number, the geometric will be a lower positive number. And then when you annualize this, you do the exact same thing you just did, but instead of raising it to the 1/3, you raise it, since it's monthly, you raise it to the 12/3. If this was 3 weeks, you would raise this to the 52/3. And again, you put your footnote down there. So that's how we do geometric and arithmetic returns. So practice this. We'll get a little bit more practice. We'll do one of these in some of our sessions, class sessions, just for practice. But practice it. And I'll probably send out some of these and let you work them for the class in the class session. So just get some practice. It's not difficult math at all, especially if you have this set up in Excel. It becomes really, really simple. All right, so what are we going to do with this? Let's use some real life numbers here. So let's bring up a company. I'm going to bring up Apple. So I'm going to go into Yahoo Finance and I'm going to find Apple. And when we bring up Apple, we have this historical data. So I'm going to bring up their historical data. I'm going to go back as far as I can. So I'm going to hit max. And I want monthly data. Hit apply. And I'll download this. So when I bring this in here, I've got Apple data. We're going to use the adjusted close. You're going to see throughout this class the adjusted close is a good number because what it does is it adjusts for stock splits and for dividends. You can see the close is adjusted for stock splits. Apple stock was not trading for 12 cents back in 1985, but when you adjust for stock splits, it is. And Apple has done quite a few stock splits. But when you also add in dividends, and Apple has been paying dividends, it adjusts it even more. That way, when we talked about the holding period return, remember we added accrued income in for the dividend. If you use adjusted close, the dividend's already in there. So you don't have to worry about that. So I'm going to get rid of everything except for the adjusted close. I'm going to adjust this to decimal places. Let's go 4. So here we have Apple. stock prices. So so this is Apple. And let's do the holding period return. So remember, the holding period return is ending market value minus beginning market value plus income divided by beginning market value. But we don't have any income here because it's already included in the price. So I'm going to do ending market value minus beginning market value plus 0, but we don't have to actually type that, divided by beginning market value. And that shows in their first month after they went live, they went IPO, they dropped 14%. So here's their returns all the way down. Some really high returns, some really low returns, but there's returns all the way down. Let's get rid of March because March isn't done yet when I'm doing this video. It might be by the time you watch it, but we'll go through February. Alright, so what can we do with all this information? Well, we can do an arithmetic average. Their arithmetic average, we can see how many periods do we have. So we'll use the count A function, go up and see we have 433 months. So what is the arithmetic average? You can just sum up all of the holding period returns and divide by 433, or you can use the average function in Excel. That will give you the exact same answer. So the arithmetic average, it's the sum of the holding period returns divided by the number of periods. Just like we did when we had 3 periods, we added up the 3 periods and divided by 3. The annualized arithmetic average, here we just take the arithmetic average, and here, since we're doing monthly, we multiply by 12. Very, very simple. So that times 12, and we get a really whopping high number, 29.43%. Alright, so that's pretty straightforward. Now, I don't have the footnote on this. Remember, we have the footnote on the other one because it's only 3 months, but this is more than 1 year of data, so we don't have to put the footnote on there. Now we get the geometric average. This is going to be much more difficult because we have to link each one of these. So I'm going to go back up to the top of the spreadsheet, and we'll start with each one. We'll really start with $1. That's what the geometric's saying. If you started with $1 and you took that dollar and you had it invested in Apple, how much would you have at the end of the first month? You'd have $1 times 1 plus your return in the first month. So at the end of the first month, you'd only have 85 cents. You'll then, the next month, take that 85% and invest it again in Apple. So you do 1 plus, and now you only have 76 cents. And you just keep doing that. If you had bought Apple, you would have lost 40% of your money in just the first 4 months. And you're probably rethinking, wow, what do I do with this company? And then you come up here after 10 months, you only have 64 cents. But then it starts looking better. In about a year and a half, you're up to 28 cents. And we just keep linking these over and over again. So I'm going to copy that all the way down. And if you had invested $1 in Apple when they first started, you would have $1,189.39 now. So what is the geometric average? Remember, this is the linked returns raised to the 1 divided by the number of periods. Very simple formula once we get this number here. So we do that raised to 1 divided by, how many periods do we have? 433, and then I forgot to put minus 1 at the end. Minus 1. Yeah, the minus 1. I can't remember if I said that earlier. So don't forget the minus 1. So you link all these together. Why do you do the minus 1? The minus 1's what we say we initially invested $1. So we're looking at what the return is. So we started with $1. we subtract that dollar, what do we end up? We end up losing 30%. So for Apple, we take the length returns. Now here, subtracting the 1, you know, it's pretty important, because if you don't subtract the 1, you get 101%. So you have to subtract 1. You made 1.65. Now you're thinking, wow, 1.65 doesn't sound very good. But remember, this is monthly. Making 1.65% every month over that 433 months. That's a really high return. Now how do we do the annualized geometric average? So here, remember, it's the exact same thing as the geometric average, but you do it to the 12 divided by 433. So it's the exact same formula. So we're going to take the 1189.39, raise it to the 1 over 433 minus 1, except for here we want to annualize, so we'll do 12, and there we get 21% as their annual return. No footnote again, because we have more than 3 months worth of data. All right, so let's think a little bit more about this arithmetic versus geometric. So here's the formulas. They're in the notes. If you're using monthly, you use 12, 52. If you're using weekly. But look at this formula right here. If you're trying to figure out the difference between arithmetic and geometric, the key is risk. The more volatile the data series you're looking at, the bigger the difference between geometric and arithmetic. And I'll show you why. But here's a formula you can use. If you take the arithmetic minus half of the standard deviation squared, the standard deviation squared is the volatility. But if you take half of the volatility, you should get the geometric. So that means we need a standard deviation. I'm going to use the standard deviation formula here, equal ST-DEVP, and I'll highlight Apple's returns. So there's their standard deviation. So let's try taking the arithmetic minus 1/2 of the standard deviation squared. I hit the wrong arithmetic. So you want the monthly. Let me do it again. You want the monthly. So you take the monthly arithmetic average return minus 1/2 times the standard deviation squared, and you get 1.67. Their actual geometric average is 1.65. So you can see it got us really, really close. The reason they're not exactly the same is Apple's not perfectly normally distributed. They have a little bit of skewing, but essentially it gets us really, really close. And that is one way you can tell if you have a population that's skewed heavily. This formula will not work. So you take the arithmetic. You don't need this for the exam. This is more just arithmetic average minus 0.5 times the standard deviation squared. That should get you close to the geometric average. Now we're talking about the monthly ones. We're not talking about the annualized numbers. The annualized numbers, this won't work at all because we're using a monthly. This is a monthly standard deviation. But using monthly averages and the monthly standard deviation squared, they should get close to each other. Now, why is the geometric always lower? Let me give you an example. Let's say your uncle comes to you with $100,000. And he wants you to invest for him. And so in month 1, and let's say we just have 2 months. In month 1, you lose 50%. In month 2, you make 50%. So there's your portfolio. And so you tell your uncle, well, here's your arithmetic average. You just take minus 50% plus 50%, you divide by 2, your arithmetic average is 0%. But how did the portfolio do? Well, the $100,000, the first month, it loses 50%, so at the end of the first month you have $50,000. Then the second month, you take that 50,000 and now you make 50,000. See how I'm linking the number? So now you have $75,000. So what is your geometric average? Well, your geometric average is, just like we did before, 1 times 1 plus a negative 50. We bring that here. So it's the same thing. A dollar would be 75 cents, $100,000 would be 70. So we just take that geometrically number, raise it to the 1 divided by 2 minus 1. So if your uncle started with $100,000 and after 2 months had $75,000, my guess is he's going to have a tough time believing that he had an average return of 0%, but that's what the arithmetic is. The geometric is minus 13%. He's probably going to buy that number better. And that 13% is that's the number that if you applied it here, if you take that 1 plus that 13%, if you did that for 2 months, you would end up with that ending value. It's the number that tells you exactly what return you got so that your beginning value becomes your ending value. This is real similar to the IRR that you use in your accounting and early finance classes. It's the true return that you got. So you might say, well, why in the world do we use arithmetic averages? Shouldn't we use geometric averages? Aren't they more accurate? Well, arithmetic is best for forecasting. Your best forecast for this portfolio is that next month it will make 0%. It's best for forecasting. The geometric is best for historical analysis of performance because it tells you the true performance. So if you want to know, well, how did I do? Well, you lost 13% on average a month. Oh, well, what would be my best guess for my return next month? Well, your best guess for your return next month is 0%. Right, now it doesn't make much sense with just 2 months. Obviously, we don't have much data to have much confidence, but that is what we're talking about here. All right, so hopefully you're getting a good sense of arithmetic versus geometric. I remember at UTSA, we were building a model, a stochastic model, or do simulation, and the financial planners wanted me to put the geometric average into the model. Well, if I put the geometric average into the model and then we ran simulations with volatility, my resulting return would have been much lower than the geometric average. I needed to put the arithmetic average in, and then when the model ran the simulations with all the volatility, my resulting geometric average would have been just about right. And so I had to show them some numbers to explain that, yeah, for forecasting into the future, arithmetic average is the right number. Because when you apply volatility to arithmetic average, you end up with the lower geometric average. All right? So there's some data for us. That's pretty good data. Now, what else can we do with this? Well, we want to talk about risk, and I just gave you a number on risk. I gave you standard deviation. So let's talk a little bit more about risk. So we've got return, we've got one number on risk. Now let's talk about other ways to measure risk. Risk with finance, we have 4 very common terms that we use quite a bit. Standard deviation, beta, correlation, and R squared. As a finance major, or really just a business major, you should know these formulas off the top of your head, exactly what they're doing. There's a lot of theory embedded in these formulas. So let's look at them and get a little bit of comfort. So we'll go back to Apple, but what we need here is we need some industry data. We need some index data. So I'm going to bring in the SPY. Well, actually, we'll just go back to the S&P 500. Alright, so I'm going to use the SPY. It's the S&P 500, but it's an exchange traded fund. We'll go back as far as we can, but Apple only goes back to January 1985, so we'll go back to December 1984. Apply, and we'll download that. So we'll have the S&P 500. We'll bring that data in. It doesn't quite go back to 85, so we won't be able to use it. I would use the S&P, but for some reason Yahoo Finance is not allowing me to bring that in. So let me copy 2193. So I'll go over to 2193. it in. Make sure we're lined up here, so 2193, and we don't need March. So that looks good, so I can just bring that price over. So we got the SPY in there. So we'll do its holding return. So we'll do ending minus beginning divided by beginning. That gives us the return for them. Copy that down. Alright, so what can we do with this information? So the real key here is to know these formulas backwards and forwards. So let's talk about these formulas. I'm going to get rid of this stuff down here. So let's talk about the standard deviation. What is the formula for standard deviation? Well, the formula for standard deviation, and I'll show you back in the PowerPoint. So these formulas are very, very similar. The first thing you do is you take a difference. So for all of them you take a difference. So for standard deviation you take the difference between each month minus the average for all of the months. For the others, you have to take a difference between, for the other three, beta, correlation, R-squared, you have to have two data sets. So you take the difference, but you need the difference for both data sets. Alright? So that's the first thing you do. So that right there tells you a lot about finance. Standard deviation, our definition of risk is how far can you be from the average, that X bar. That's our whole focus of risk in finances. How far can you be from the average? The others, what we're going to focus on is when one's above or below its average, is the other also above or below its average, or is its opposite? If this one's above its average, when this one's also above its average, and this one's below its average, when this one's below, then you're going to get a high positive number. If this one's above when this one's below, and this one's below when this one's above, you'll get a negative number. So standard deviation's only focused on how far can you get from the average. These are focused on when you're above the average, what's the other data set doing? It's above its average or below its average. But in finance, we're always focused on this average. You might have heard this term referred to as the expected value, which is kind of a crazy term because we don't really expect it. It's just the historical average, but we use that term expected value. It's what's somewhat in the middle of the distribution of this data, this collection of data historically. The second thing you do is multiply. For standard deviation, you're essentially squaring the difference by itself. So you're multiplying the number by itself. So you cannot get any negative numbers here. If you're below the average, you have a negative number times a negative number, you get a positive number. If you're above the average, it's positive times positive, you get a positive number. Also, standard deviation is very sensitive to outliers because of this squaring process. For the others, you can get a negative number. If this one's above when that one's below, you get a negative number. But you also multiply, but here you don't multiply it by itself. You multiply each number by the other number. The next step you do is you take the average of these multiplications. Doesn't matter whether you're doing standard deviation or you're doing correlation or beta or R-squared, you take the average. Now, the average for these is known as the covariance. So the covariance is when you multiply these two data sets, differences from averages together, you take the average of that, that's called the covariance. And step four is where the formulas vary. Standard deviation, you take the square root of that average. Correlation, you take the covariance and you divide it by the standard deviation of this first series times the standard deviation of the second series. That's correlation. R-squared, you just take correlation and square it. For beta, you take covariance, so you see how all three of these use covariance, but for beta you use covariance, but you don't divide by the standard deviation of X and the standard deviation of Y. You only use Y, assuming Y is the market. So for beta, we only care about market risk. For correlation, you use both. This is also known as a slope function in Excel. Alright? So let's see if we can do these. This is something I highly recommend that you do. If you try this on your own, it's not dangerous. You could do it. You won't get hurt doing this. So let's start with standard deviation. Remember what we said with standard deviation. We're going to come down here to where we have data. So here's the SPY. And then this is Apple. So here we have Apple's data. Let's put a break in here just so we can see it. So here we have Apple. Here we have the SPY. So what was the first thing we did? We did the difference. So the difference with Apple and a difference with SPYs. So we got the, let's get the averages. So the average for Apple we've already seen that, except for this is a different period of time, is 253. For the market, it's 0.89%. Obviously, Apple's had a much higher return than the market. Now we'll do the difference from the average. So we take Apple, in this month, they made negative 262, subtract the average. There's the difference in the average. Do the same thing for the S&P 500. We take the S&P 500 return minus the average, and there's the difference. And then we copy those down. We want to do them for every single period. Alright. Now for correlation, beta and R squared, we're going to multiply these two differences by each other. So the Apple difference times the SPY difference. For standard deviation, for Apple, we're actually going to square its difference. And the same thing for the SPY. We're going to square that difference. So the first difference for Apple was 514 negative. You square that, you get 0.0026. For the S&P, you had a number of 0.0087. You square that, you get a really small number. And then when you multiply the differences, you get a really small number as well. All of these ratios are very sensitive to outliers. So we're going to copy all of these down. And then we're going to do the averages again. So equal average of the square differences for Apple and S&P, and the average of the multiplications of the differences. Remember, this number right here is called covariance. And then to get standard deviation for Apple, all we do is take the average, take the square root of the square difference, the average of the square difference. We got the difference from the mean, we squared the difference from the mean, we got the average of that square difference, we take the square root of that, we get that. Let's test it. Equal STDEVP. Let's go back over to our Apple data, and let's see if we get that standard deviation. And sure enough, we get the exact same answer. Now let's do that for the SPY. So we take the average of the differences and take the square root. Get 420 now. 428 sounds really low, but we were using monthly data. So using monthly data, you expect a much lower number. Now let's get the actual calculated number. And sure enough, we get the exact same answer. Now let's look at correlation. Correlation, here we can just do Apple to the market because we only have two things here. So remember, for this, we take the covariance and divide it by the standard deviation of Apple times the standard deviation of SPY. And that gives us correlation. Let's check that. Equals CORREL in Excel. We highlight Apple's returns, comma, the stock market returns. Make sure you know which one's the market returns versus the differences. I should have highlighted that better. That gives us the correlation, and it's the exact same number. R squared, you take the correlation times the correlation, that gives you 20 or 20%. We usually say, so what do we mean with this 20%? 20% of the volatility in Apple's stock monthly stock performance can be explained by the volatility in the S&P. We're going to talk a little bit here about beta with systematic and unsystematic risk. What that means is 80% of the risk of Apple is unsystematic, which means 80% of the risk of Apple stock disappears as soon as you put it into a portfolio. Well, we'll talk about that more. We can do this as well, R squared for Apple returns. Remember to use Apple returns, not the differences. And the S&P 500, its returns. That should give us the R squared, and sure enough, there's our R squared. And then we'll do beta. So what do we do with beta? So again, we can only do beta versus the markets. So we do the covariance divided by, but here we don't use the Apple standard deviation, we only use the markets. So we can get a number greater than 1, we get 1.29. Let's check that. We can use the slope function. So we do the slope of Apple's returns versus the S&P 500 returns. We get the exact same answer. So I strongly recommend your brain will catch on to these if you manually do these formulas. So I strongly recommend, you do the formula yourself. You saw the steps. You can pause this video. So we have to have Apple's returns. We have to have the S&P returns. We have to have the differences for Apple and SPY versus to the mean. For Apple, we take this, and SPY, we take the square the differences. So we do that there. And for correlation, we multiply the differences. And then you take the averages of these numbers. So there's the averages. And that gives you these numbers, and then at the very end you just plug them into the formula. Standard deviation is just the average of those differences squared, taking the square root. Same thing for SPY. For the correlation, you take the average of those two differences multiplied by each other and divided by the standard deviation of Apple times the standard deviation of SPY, and that gives you correlation. For R squared is just the correlation squared. And then beta is you take the covariance, but here you only use the standard deviation of the market, and we get a beta of 1.29. Now we're going to talk quite a bit about beta. We will not be using R squared, correlation, and standard deviation in the rest of our class. So those are not terms we need for this class because we're focused on investments, and beta is the big number for investments. But you do need correlation, R squared, standard deviation for other applications. So get to know them. I've known some people in finance who did not know these formulas. I remember one graduate level class, a finance class, a friend of mine was taking this class, and he came back to work and said they were trying to calculate the standard deviation of one number. Well, one number, the average of one number is that number. That number minus itself is 0. You square 0, you get 0. The average of 0 is 0. There is no standard deviation of one number. So, so it just shows they didn't quite understand the concept. I think I got at least 1 or 2 promotions just by knowing these formulas. I had people I was working with that didn't know these formulas, and because I knew them, gave me a huge advantage in talking about the data, but also setting up models. So I know it's all right here, right? It's all right there. Excel does all the formulas for you. So you can do STDEVP. That's the standard deviation for our population. If you just do STDEV, you'll do a sample. They're almost the exact same number. For correlation, you use the CORREL function. and then you have to put the data for A and the data for B. For R squared, it's just well, what exactly? RSQ, and then you A and B. R, you just take correlation squared. And in beta, you use the slope function for A and B. And make sure you do the market as B. The market has to equal B. The market is almost always the S&P 500, even though theoretically that's not what the developer of beta said. But anyway, so you can definitely use Excel. However, Excel's doing all the work for you. You're much better off if you can do it by hand, so you know exactly what these formulas are doing, so you understand, first of all, what they're measuring, how sensitive they are to outliers, and then when you have a period like 2020, when you get really radical numbers, you can see how those periods can really distort these numbers. Alright, so I'm hoping you know these formulas now, remember them from your stats class. Hopefully your stats class actually taught you the power of these functions and how to use them and what they mean for finance. You just weren't plugging numbers. Sometimes stats professors get a little too much into the weeds and forget to step back. Sometimes my stats professor was a TA, and he just said, just learn the formulas. He never once in the entire class stepped back to say, hey, here's the power of this. That's why I recommend that book Naked Statistics, because he does a great job of saying, hey, here's the stats that you learned, but what can you do with it? Let me show you the powerful questions you can answer knowing this stuff. All right, so for a portfolio where it's everything you have, your entire portfolio, standard deviation is the best measure of risk, because that's what you're worried about. That's called total risk. It's all of your risk. Since it's your entire portfolio, you want to look at that standard deviation. So it tells you how far away you can get from the expected value. It ignores whether you're above average or below average. So if you expect to make 6%, but you're up 30-something%, standard deviation is going to say, wow, that's really risky. Why? Well, because if you can be well above the average, you can also be well below the average, assuming you have a normally distributed distribution of data. Then, yeah, being way above the average is an indication that being way below the average can be an issue. Now, there is a formula called semivariance, and it focuses on how risky things are when they're below the average. That is important for certain asset classes. It tends not to give you a radically different answer, but I remember early in my career, there was a gentleman named Brian Rahm, probably 8-9 years into my career, a gentleman named Brian Rahm, and he wrote an article saying we should be doing all of our risk analysis with semivariance. He actually had a software package, so I called him to talk to him. He had several articles in the Financial Analyst Journal. In fact, he and Roger Ibbotson were having a big public debate in the Financial Analyst Journal. I called him. The unfortunate thing about his model is it was pretty easy to replicate in Excel. So I didn't really need to buy his model. I was able to do everything he was doing myself in Excel. But the fact that he was selling software gave me an excuse to call and talk to him, and I talked to him quite a bit. I think he's still out there. It's Brian Rahm, R-O-M. I'm not sure how well his product did, but he was adamant that semivariance gave you very different efficient frontiers than variance. Ibbotson disagreed with him, so there's some debate whether standard deviation is really the right measure to use, but it's the standard right now. It's the most common that we use. It is very sensitive to outliers, but we won't use standard deviation much in this class. Why? Because we're focused on individual stocks, and we're going to be using William Sharpe's capital asset pricing model. And what he said is you can break risk into two components: systematic risk and unsystematic risk. Systematic risk is measured by beta, and beta is a measure of, and this is real important, that you put the word relative amount of systematic risk of each stock. Beta does not tell you how much systematic risk you have. It tells you your systematic risk versus the stock market. So if the stock market's beta is 1, so if your beta is like Apple, 1.29, then that means you have 29% more systematic risk than the market. For that systematic risk part of your risk, you're 29% more risky. Now remember, with Apple, their R squared was 20%. That means for Apple, 20% of the standard deviation of Apple, 20% of that risk is systematic. 80% is unsystematic. Unsystematic risk, you can eliminate it simply by diversifying your portfolio. That's the powerful theory of the capital asset pricing model. It's a one-factor model. It compares a stock to the market. Essentially what he's saying is all those systematic risk. So all of that, all of those things, interest rates, the economy, all of those things, William Sharp is saying that's captured in the stock market itself. So if we correlate each stock to the overall market and use it as a slope, so all the noise around the slope gets ignored, we just look at the slope, then all of that should be captured by the stock market. The stock market is sensitive to interest rates and inflation and the economy. And so when we correlate and get the slope of our stock to the stock market itself, we're picking up all of those systematic risks. Now that's generally true. The problem is certain stocks are sensitive to certain systematic risk versus others. Obviously, bank stocks are more sensitive to interest rates. Retail stocks are more sensitive to employment and the economy, the overall economy. So it can vary. So these things can vary over time, and that's part of the complaint with the capital asset pricing model. In fact, if you want to look up and get a sense of what people think about the capital asset pricing model, just go on the internet and on Google or wherever and just type, "Is beta dead?" Is beta dead? And you will have hundreds of thousands of articles come up, all talking about, and you'll see articles like beta's dead again, is beta still dead, is beta alive? All these, that particular title is frequently used in articles. But this is the theory. We're going to go with this theory. Not because it's simple or it's what we have to do because of academia, but as I heard it explained, the capital asset pricing model is the worst model there is except for all the other alternatives. It's still, for most of us, except for the really quantitative hedge fund managers maybe, capital asset pricing model is still the best that we have. So the beta of a portfolio, if you have a portfolio of stocks, your beta of your portfolio is just the weighted average of each of those stocks. So we talked about this earlier for exam 1 when we were talking about beta, when we were talking about stocks and their characteristics. If you're worried about a recession, then you're going to want lower beta stocks. You sell your high beta stocks, buy lower beta stocks. If you think it's going to be a strong economy, then you sell your low beta stocks, add high beta stocks, and your portfolio just will move proportionately. So if unsystematic risk can disappear at almost no cost, all you've got to do is buy a well-diversified portfolio, which is easy to do. You can just go to Vanguard and buy a portfolio with a few hundred stocks in it. Then what the capital asset pricing model says is you should not be compensated for taking that risk. If you put all of your money in one stock, you will have a very volatile portfolio. You saw that Apple's standard deviation was 3 times higher than the standard deviation of the S&P 500. You saw that you lost 40% of your money with Apple if you'd bought it when it first went public. In just 4 months, 5 months, you would have lost almost half your money. But 80% of that risk will disappear if you put it in a diversified portfolio. So William Sharp says you should not be compensated for taking unsystematic risk. Another way he says it, systematic risk is the only relevant risk. It's the only risk that you're actually compensated for. So here's the formula that we just showed. We just did in Excel. You can do it like this, or you can use the float function. We're going to be doing this in Excel. You're going to have, when you do paper 3, you're going to be required to actually calculate what I call the rolling beta, and so we'll get into that, and I'll show you that once we get into papers 3 and 4. For individual stocks, standard deviation is dangerous, but for individual bonds, it's even more dangerous. For individual stocks, standard deviation as a measure of risk, it doesn't reflect the fact that when one stock has bad news, another stock has good news, and so it offsets each other. But for bonds, it's even more dangerous because bonds are not normally distributed. If you have a bond paying you 6%, the best you're going to do is make 6%. But if it goes insolvent, you could lose 100%. So it's very skewed to the downside. For stocks, you might have a stock that loses 100%, but you could also have a investment in Zoom that's up 300%. So it's possible for stocks, even if you lose 100%, that another stock could be up 20, 30, 40, 50%, or 2 or 3 other stocks could be up, and that could protect you. You cannot get that with bonds. So with bonds, remember with bonds, we use duration and convexity as our main measure of risk because we're worried about their interest rate risk, or we use credit ratings and credit spreads to measure their credit risk. So bonds, very, very different type of analysis than with stocks. So we're going to get into beta and talk more about beta. What I want to do, and I'm gonna touch on it today, and then we're going to get into it in much more detail next class. Next class is really important to really help you get ready for paper 3. But most finance classes teach beta as something that you calculate. Well, the problem with calculating beta is that's a historical number. And so if it's a historical number, what may be true in the past may not be true in the future. So you have these two risks, systematic risk and unsystematic risk. Because you have multiple of these, what a firm's risk beta has been in the past might not be true going forward. The world is changing dramatically. There's some times where the market's really focused on interest rates and inflation like it was in the 70s and 80s. And so those stocks that are very sensitive to interest rates and inflation, they're going to have much higher betas during those times. There's times when the market's really focused on oil prices. At those times, stocks like Exxon and Chevron are going to have much higher betas. So it just varies over time. Every stock has systematic risk. You can calculate it what it has been historically. The question is, what is it going forward? But beta is a measure of relative systematic risk. So again, you've got to be cognizant of that. It's just looking at what is your systematic risk relative to the average stock when the average stock has a beta of 1. There are other models out there. Arbitrage pricing theory is the one I heard the most of. I gave you a link in the notes to MSCI, used to be Morgan Stanley, but now it's MSCI. They bought the most famous of those APT models, which is the Barra model. They used to have all their factors listed that you could see them, but they've somewhat gone proprietary on that now. But so there are other models. I'm not saying Capium is the only one out there. It's the one that's primarily used undergraduate and even graduate school. A stock with a high beta is going to be what we call more cyclical. Things like durable goods and luxuries. A stock with a low beta is going to be defensive. They sell consumer staples, healthcare, grocery stores, utilities. So beta for Apple is 1.2. We don't say Apple's systematic risk is 1.2. We say Apple has 20% more systematic risk than the average stock. Beta is unlimited. It could be negative 5 million. It could be positive 5 million. But the typical range, and this is really important for your paper 3, the typical range is from 0.4, maybe for a grocery store, up to 3, maybe for a firm like Ford that's selling a discretionary product, a very expensive product, and the firm has a lot of debt. And we'll talk about debt here. So are we going to just calculate the historical beta and use that? Most undergraduate students probably do that in finance. But I don't believe that. That's what we call a regression beta. To me, regression beta is just what history has told you. I think we should use a forecast beta. And I've been doing this for several years because I had a portfolio manager speak to my class once, and he showed just how volatile, unstable betas are. And so I started saying, rather than using historical betas, let's sit down and look at the company and talk about it. And the historical beta will be one input. Let's talk about the company and see what makes sense and do a forecast beta. And in several years after doing that, I watched a video from Dr. Damodaran, the professor of finance from New York Stern School of Business. And my word, his approach was identical to mine. I was amazed. So I didn't know about his approach. I'm absolutely sure he didn't copy my approach. but it just seemed logical to me. So they gave me quite a bit of confidence as someone of his popularity and stature. He's doing the same thing I am. So I feel very comfortable. This is a very good approach to use. So my quote is I'll I even this if you ask my students that have had me before, they can quote this for you. Beta is not a number you look up in Yahoo Finance. Yahoo Finance will give you a beta, but it's just that regression beta for the last 5 years. Beta is a forecast. So that's what we'll start with next time, talking about forecasting a beta. Real quickly before that, what is unsystematic risk? Unsystematic risks are those things that are specifically tied to the company. That something happens to the CEO, they offer a new product, they go into a new market, or maybe they have a product that's not approved by the regulators, a competitor does something, a disaster hits the headlines. We can ignore those risks. Why? Because they're eliminated easily by just diversifying your portfolio. You're not going to get a higher expected return because you have a firm that has high unsystematic risk, because you can eliminate those. This is one of the reasons firms go public. If you're a private firm, your cost of capital is going to reflect both systematic and unsystematic risk, because that's all your risk. You can't diversify because you can't put a private firm into a well-diversified portfolio because it's not tradable. So your discount rate, when you're valuing an HEB, your discount rate might be 25%. You have to have a discount rate that covers you both systematic and unsystematic. And remember, unsystematic risk can be 70–80% of the risk. So if you value HEB as a private firm, you might get a valuation, say, of $500 million. I have no earthly idea. I don't know what HEB might be worth, but it might be worth $500 million. As soon as HEB goes public, their discount rate's going to drop dramatically, maybe from 25% to 8%, or probably even lower. The value of HEB might go from $500 million to $6 billion, or who knows what it might be. So if you're a member of the HEB family, if you're a member of the Butt family, you have a strong incentive to go public, because the value of your company is going to go up tremendously because your discount rate is going to go up. So next class, what I want to show you, first I want to show you visually how beta works, how diversification works, and then I want to talk about forecasting beta.